Alrighty, so I'll quickly introduce our speaker. But before, I want to introduce our Small Business Essential series and just talk a little bit about that. So this series started last month with our creating a loyalty program that was hosted by Paul Cavalieri, who happens to be a small business growth coach, small business growth coach, and also a Polsky staff. And this month's topic, we are covering cash management and pivot to profit with David. But we'd like to highlight our sponsor, MUFG Union Bank. If you'd like to visit the website, you can go to mufgunionbank.com. And without further ado, I will introduce our speaker. David Johnson is the founder and managing partner of Abraxas Group. Did I butcher that, David?
It's okay. It's called Abraxas.
Abraxas. I always forget. I'm sorry. It has a 20-year track record of driving organizational change. David has served as an interim executive, a financial advisor to dozens of middle market companies in transition. Throughout his career, David has demonstrated a commitment to thought leadership with numerous speaking engagements and articles on the topics of business transformation, change management, performance improvement, restructuring, turnaround, and value creation. To his credit, David received his MBA from the University of Chicago and completed his undergraduate studies at Farley Dickinson University. Most of all, David is super humble, so he's definitely very approachable. So we're fortunate to have him today, and I'll let him transition and begin the workshop. Thank you, David.
Sure. Isra, thank you so much. Thank you to everyone who is sharing their time today. I certainly appreciate it, and I'm humbled by it. I would like to thank EJ, Reedy, Isra Omar, and the entire Polsky staff for the opportunity to share their platform. I will be going through a presentation, but I have found that these discussions are best when they are discussions. Please feel free to interject when you have a question or a comment. Isra is a very seasoned moderator, and I know she will have some questions ready at the end, but I often find it helps with the flow if questions are asked as they occur to people. So with that, we're going to jump into the presentation. Isra, can you see my screen? Okay, great. As we think about what is going on this year, it's important to understand that companies need to take a hard look at their strategy in the wake of a new paradigm. The challenge of 2020 for many business owners and for those in the advisory class has been, there's been a tendency to cross our fingers and hope that this will end soon. At some point, we simply have to engage with reality as it is today and set aside things that are beyond our control for those that can control them. The reality is we are in a recession, in some segments of the economy, a rather severe recession, and companies need to take a hard look at what they need to do to not only survive, but to thrive in this environment. Very simply, the growth outlook for many companies is negative. That makes a lot of sense at a high level. Recession is definitionally a situation in which the economy is shrinking. Some companies are fortunate enough to grow faster than the market, but it is difficult. Luckily for business owners and business leaders, growth is not the only value creation lever that businesses can employ. We are at an optimal time for business owners and their leadership to reacquaint themselves with equally proven, though somewhat less sexy, methods of driving value. When I think about value creation characteristics that are the most desirable, to me, it gets down to three. A good value creation measure or lever is going to be something that's actionable. You focus on what can be directly influenced. Next, you want to think about the scope of impact. Not every measure is going to have the same level of impact on company performance. You focus on things that are going to have an outsized and positive impact when that measure is optimized. And last, you want to focus on measures that are scalable. Some opportunities are attractive opportunities, but they are not what I would call evergreen. You seize the opportunity and you get a one-time bump. There are other measures that when you optimize them, that optimized measure continues to pay dividends as the company grows. And that's exactly what you want. In terms of generating improvement, especially in the context of a pivot, it's very challenging. It's important to start with a thesis and to move on to goals, then focus on execution. When you think about developing a thesis, it is vital to understand where you're headed and what success looks like. I can't stress this last point enough. Too many incredibly successful individuals and highly successful companies embark on a strategic pivot without a clear idea of what success looks like. And unfortunately, they miss it or they go right past it. There should be objective measures of success. And you and your team should have a clear understanding as you embark on a pivot of what it would mean to be successful, what it would look like to be successful in this new paradigm. For illustration purposes, I listed 3 items that might be appropriate goals for a company seeking to execute a strategic pivot to help you think about it. Increasing gross margin by 5 percentage points. Now that's something that's easily and objectively measurable. You can clearly see when it happened. Decrease net working capital by 10%. Again, can clearly grasp that it was attained. And calculate the cost of customer acquisition, because many small businesses don't know what it is, and reduce it by 20%. Now, getting back to the value creation characteristics, each one of those example items are actionable, have a favorable scope of impact, and are scalable. They will continue to pay dividends as the company grows. In thinking about unit economics, I would call in many ways unit economics are often sacrificed on the altar of growth. As companies are pursuing aggressive growth strategies, they tend to find that maximizing revenue growth at the margin is going to be associated with gross margin erosion. When you find yourself in an environment in which growth is challenging, that is an opportune time to look to optimize your gross margin. Look to optimize how much you make on every unit sold. Growth will return, but the discipline of optimizing your gross margin should carry over at least through the early stages of a return to growth. In terms of increasing gross margin, you can put it into a little bit of a process. You start with analyzing sales. You calculate your gross margin by product, by service, and by customer. It is very common that you are going to see large discrepancies jump out, even from that initial level of analysis. Even at some very large companies I've advised, products and services quickly reveal themselves under this level of scrutiny to have unacceptably low margins. Often there are customers that have unacceptably low margins. It's important to understand this because as we think about gross margin at a company level, it's an aggregate. You really want to be able to disaggregate it and understand all of the component parts. Optimizing very often is just that, understanding the component parts of a measure and seeking to emphasize those parts that are most favorable for the company and de-emphasize the others. After you've looked at those discrepancies, a pro forma analysis will help you understand what the impact of changes would be. What would happen if you got rid of your low or negative margin products or services or customers? It is not uncommon at all for a company that has not been focused on optimizing its gross margin to find that considerable product lines or service lines and sometimes sizable customers are actually dragging performance down, and the company would be better off with a lower level of revenue but a higher level of gross profit and gross margin by getting rid of those laggards. In thinking about working capital, it's best to understand that working capital is simply the capital tied up in the core operations of a business. This formula is a little bit of a shortcut, but it's a quick rubric to understand how to think about it for a business owner. Working capital can be thought of as accounts receivable plus your inventory, less your accounts payable. When leadership seeks to optimize a company's working capital, it's increasing the capital efficiency of a business. It is essentially lowering the amount of capital a business needs to fund its operations at a given size. Any increase in accounts receivable or inventory at a given size is going to be a use of cash. Any increase in accounts payable is essentially your suppliers providing you credit, and that's a source of cash. The goal is to minimize your net working capital and to have a tight view on it so that as growth opportunities return, you have optimized your company's working capital needs and your company's capital efficiency. When working capital is optimized, it costs less to grow. A company will need less financing, it will need less debt capital, it will need less equity capital to grow, and it will be that much more attractive to investors. Ironically, some of the most attractive companies to investors are the very companies that do not need investment. How to go about optimizing working capital. Look to decrease your accounts receivable by changing the pace of your collections activity. Many companies do not contact their customers to collect their accounts receivable until amounts are past due. Companies should reach out on a very regular basis, far in advance of the due date for an invoice, to confirm that the amount is due and confirm that payment will be on time. Offering incentives for earlier prepayment is another opportunity to pull in cash sooner, cash that is owed to your business. And then making sure that there's a communication strategy paired with all this so that your customers you are of strategic import to your customers and they understand their strategic importance to you. Those type of relationships can really make the difference when a company is deciding which supplier to pay. Those personal relationships can make the difference between getting paid this week or next week, or getting paid on time versus being stretched a little bit. All things being considered, you would prefer that the other guy gets stretched, not you. Not all companies have inventory, but for those companies whose business models require it, it's important to take a look and a hard look at reducing the number of products. A very large catalog of products can lead to a much higher level of inventory, a lower level of efficiency in terms of the average sales per product, and the current downturn might be an opportunity to cull your catalog a little bit. Take a hard look at how you're ordering and forecasting demand. Faulty demand forecast, if, for instance, you forecast demand that's 20% higher than actual, can leave a company with a lot of inventory that is moving very slowly. Inventory is your cash dressed up in disguise, and most small and mid-sized businesses would rather have the cash. Also, again, communication. Look to lock in lead times with your key suppliers. You don't need as much of a safety stock if you have comfort that you know how long it will take you to get your materials when you order them. That can be crucial to further pushing down your inventory levels. In terms of accounts payable, all things being considered, you'd rather your accounts payable balance goes up. Negotiate your credit limit increases with suppliers. A lot of times this can be as simple as reaching out to your key suppliers, explaining to them that you would like to do more business with them, but that your current credit limit is inhibiting that level of business. If you can appeal to the business sense of your counterparties, a lot of times you will get a favorable hearing. Take a hard look at how you manage payments. Many companies pay invoices just as they come in, and it hampers their cash management process. You should have an orderly process. You shouldn't be paying invoices more than once a week. And there should be, there should be strict objective criteria for deciding who gets paid and when. And also increase your communication. Make sure your suppliers understand what your process is, what you need to get them paid, and the challenges you are facing. This doesn't mean that you reach out to your customers in the midst of a cash crisis, although that happens sometimes. Ideally, you want to have firm and strong relationships with your suppliers so that if you find yourself in a point where you are going to need to stretch your vendors a little bit, you have a reservoir of goodwill to draw on. It's always more helpful when you have a relationship on the other end of the phone. In the broader market, analytics have gotten a lot of attention. And one of the things that I've been sad to see this year and in prior years is the importance has not fully filtered down to small and mid-sized businesses. Successful companies understand that data-driven insights are the one universal value creation opportunity. And by that, I mean that every single company has an opportunity to master its own information and draw actionable insights out of the mastery of that information to improve their own performance. Every company. And a lot of times the analysis is not particularly hard. Investing in data reporting and analysis drives high-performing companies to develop crucial insights into themselves and their markets and pushes out the frontier of that insight. Those are opportunities that every company, regardless of size, has. It can start with a spreadsheet. It can start with a calculation on the back of a napkin and get more advanced from there. But it is absolutely crucial in this day and age that every company take that first step, if it hasn't already, to mastering its information. Again, optimizing analytics can start small, but it will pay enormous dividends. You start by, I'm sorry, was there a question? You start by identifying promising areas of inquiry. You identify the data source or sources available. Try to determine how you'll benchmark. Benchmarking can be very important. One of the challenges of an analytics exercise is you'll calculate some measures, but it's difficult to understand if those are good or bad. You know for yourself that certain measures, if the number goes up, that's good, so you would like it to go up, but you don't know how high up was good. Are you a top performer? Are you a bottom quintile performer? First, get the information, then calculate. But once you get to the question about benchmarking, you should really look into third-party benchmarks. It can do a lot to drive value. And then analyze. The analysis isn't everything, but the analysis is key to driving insight. Analysis will foster those aha moments that will lead business owners and their leaders to seeing ways that they can make their company better. And some of those ways are small, but some of those ways are fundamental and can really take a business to the next level, regardless of the growth environment. A lot of business owners and managers will manage to an income statement. And in an environment of plentiful capital and a positive growth environment, that might be an acceptable way to manage. Unfortunately, in a recessionary environment, management by reference to the income statement can be incredibly dangerous. And I put together some exhibits to illustrate just this point. Now, this income statement and the exhibit you're going to see on the next page, these are all hypothetical values. They are not from any company, and it's just for illustrative purposes. But here we see a forecast for Q4 of 2020. Now, this forecast, the company is about breaking even on an operating income level and losing just about $17,000 on a net income level. The challenge for company leadership is how much of a cushion does this company need? Is this company in a good situation if it has $25,000 in the bank to start this quarter? Does it need more? And how do you think about that? When you look at the same period broken out into a 13-week cash flow forecast, again, the very same numbers, you start to see how important it is to differentiate between profitability, which is revenue less expenses, without regard to timing, and the timing. Cash flow is about timing. So when we look at, again, the same period, when we look at this period, we see this company is forecast to lose not quite $17,000. When we look at a cash flow forecast, we see that this company is going to burn over $72,000. Timing is everything. Profitability matters. But in the short term, cash flow matters more for a business. By optimizing unit economics, i.e. your gross margin, you will make a company more profitable in the long run. But you're going to have to make it to the long run first. Companies can master their cash flow by focusing on a weekly cash flow forecast, that's this exhibit here, to optimize their working capital, to understand the impact of speeding up collections, to understand the impact of concessions from suppliers and a lower level of inventory. And please, if you take nothing away from this, understand that growth does not save companies in a recession. Cash flow and planning does. Isra already said most of these things, but these are some of the things that I'm proudest of. So I'll say that, again, I have a 20-year track record of working with small and mid-sized companies driving this change. And I hope we can go into your questions now. Thank you so much.
Thank you, David. If you guys have any questions, feel free to ask. You can unmute yourself as well, or put it in the chat if you prefer.
Well, Isra, you've gone through this before, so is there anything that I can answer for you while we wait?
Can you go a little bit into like cash flow? Because I know you just mentioned that growth is an indicator, but if you can just go a little bit into that.
Yeah, so the important thing to understand about cash flow is there would be no difference between an income statement and a cash flow forecast if it weren't for timing. But every business owner understands that timing can make or break your business. So when we look at this cash flow forecast, what you're looking at is the impact of timing. The income statement items are unchanged. It's the same revenue, the same cost of goods sold, the same expenses, but those items don't hit at the same time. Revenue that is generated in a given month is very frequently collected later, not in the same month. Purchases that are made in a given month can be collected at different times. The timing of payroll, the timing of rent, all of these small things aggregate to an enormous tactical and timing difference. And the importance of the discipline of cash management and a cash flow forecast, this type of tool, which I tend to implement with all of my clients, is giving the leadership of a company visibility into the next quarter, the 13-week period, a 3-month span, to understand what's coming in, what's going out, and what the aggregate picture looks like. So the discipline is, if I simply looked at an income statement forecast for the same period, I would see a $17,000 loss. And I might not consider that bad for a company that had that's projected to have almost 300,000 in revenue for a quarter. But when I break it down by week, by the direct receipts and disbursements, the direct inflows and outflows, I see that I've got a real problem. I see that actually I don't need 17,000. I need at least $72,000 just to keep my head above water. And knowing that ahead of time can save a company.
Thank you, David. So I have two questions from Nasser. You mentioned data insights and captures. What tools do you recommend? And the second question is, a lot of cash burn happens from marketing and advertising.
Yes.
What are key mistakes to avoid?
Great questions. I'm going to take them one at a time. In terms of the sources of information, I am a big proponent on starting with a small number of measures that a company has easy access to. So I would look first at, it really depends on what you're looking for, but I would look first at the data that is most readily at hand. If you're going too far afield, I think that can be a signal that you're missing some opportunities closer to home. There are a lot of analytics opportunities simply in rigorous analysis of your financials, but rigorous analysis of your financial performance with some overlay of operations can really, for companies at a pretty sizable level, can really give some valuable insights. In terms of the cash burn related to marketing, I like nothing more than when I'm able to help my clients return to growth. But too often, companies will chase growth in an environment where growth is going to be very hard to come by. And the most important thing a company can understand is what is that company's individual best path to win. It is often not the case that a company will be better off with an extra $500,000 of sales. It's often the case that there are other measures that the company has more internal measures, has more control over, that would allow the company to be more profitable, to have superior cash flow. And again, those are measures that a company has more control over and can then be better positioned for growth when the environment is more favorable for growth. If marketing spend looks merely like cash burn month in and month out, that's a good signal that you may be overspending in a market where the growth opportunity isn't there, or for whatever reason, the value, your company's value proposition isn't clicking with the market. So it might be time to pull back and reassess. It is never the case that you should just shovel money down. That's telling you something if it feels like an expense rather than an investment.
Thank you, David. Nasser, I hope that answers your question. So we have a question from Dimitri. Any advice to CFO of Wirecard? I've never heard, haven't heard of Wirecard. Dimitri, is Wirecard your business, or if you can clarify? And I guess
a sizable German company that had a little bit of a fraud issue.
Oh, okay. Well, the question is how to manage cash flows.
So I have been the CFO of companies when there's been a fraud issue. And the thing to keep in mind, and it holds in business regardless, is to be open and honest. What in the situation that I'm thinking of that I think most closely ties to this, I was brought in as CFO of a private equity-backed construction company that restated 3 years of financials. That restatement evaporated $23 million of profit, and the company was automatically in default of $100 million of assorted first and second lien loans. Everyone was angry. People were talking about sending the former executive team to jail. The company was immediately placed in workout, and suppliers were nervous about getting paid. And I was put in the CFO seat. The thing that helped me navigate that company through that time was clear communication with all of the stakeholders. It has to be appropriate. You don't tell people more than they deserve based on their position, but you tell them as much as you can. So to the lenders, I explained what we were doing. I explained what our position was. I instituted this type of weekly cash reporting, and we had a weekly call for the next 12 months to walk the lenders through what our cash position was at that week, what we thought it was going to be for the next 3 months, and what we were doing to manage through. I started having regular calls with our key suppliers, and they stopped panicking. And as a result, we returned to growth. We were able to restructure our debt, and that company sold at north of $200 million more than it was worth the day that I walked in, because we bought ourselves some time. Honesty, being calm in the face of a crisis, and providing good and unimpeachable data will get you very far.
Thank you, David.
Of course.
We'll take some last minute questions. Again, if you'd like to ask a question, you can unmute yourself or put it in the chat. I think we'll give people a minute or two.
Okay, no problem.
Now we'll wrap up.
One thing I do want to make sure the audience understands, because I know they're all seasoned professionals and accomplished entrepreneurs. This is an interesting time. Recessions are proven time and time again to be excellent value creation opportunities. This is a time to strengthen companies. This is a time to emphasize the less sexy parts of running a business, but emphasizing and optimizing those measures now position companies for considerable growth and value creation when the market turns. This is when the best companies are built.